about environmental, social, and governance reporting. This is, kind of brings us out of SEC PCB regulation, but not entirely. So this is a very new area. This is not a new area. It's been around for a while. Has a lot to do with kind of global warming, corporate social responsibility. You've heard all those terms before. ESG encompasses all of those themes. But what's interesting about it, while the topic itself is not new at all, it kind of has gotten much more popular lately. I would say even I was listening to a couple of podcasts this week, both from the investor side and from the company side. Investors now are much more interested in ESG trading strategies. There's ESG risk exposure from the perspective of how you treat your employees and the diversity side of things. Of course, global warming, carbon emissions has not gone anywhere. It's still very much a concern to everybody. There's a whole debate about whether ESG, high quality ESG firms, whatever you want to call it, outperform the market and so on. So since this is an ethics CPE, and this is a topic very much related to kind of stakeholder shareholder debate and ethics debate, I wanted to spend a few minutes and talk about that. So some of the key challenges with assessing the impact of ESG is whether in fact it's value enhancing or not. So PwC published this white paper that kind of lays out how ESG, environmental social governance, quality compliance could help companies. So obviously the stock price could either go up because of cash flows expectations or through reduction in the firm risk, which we academics like to call reduction in the cost of capital. Obviously there's different channels through which it could happen. One could argue, for example, that greater commitment to diversity could help companies hire better talent, increase variety of perspectives, increase levels of creativity, kind of entrepreneurship within the firm. Also could increase loyalty of its customers when they see that the company is committed to kind of being more socially responsible, treating their employees better. Obviously, carbon risk, is a huge deal, especially for companies that are, exposed to it. I mean, we're talking about global warming, climate change, and so on. If you're a long-term investor and if you're concerned about it, and most long-term investors increasingly are concerned about it, especially in light of kind of greater volatility with the hurricanes and so on. Those things, affect both expectations of your cash flows and firm risk. Because in some ways, if you're exposed to climate change, your supply chain is exposed to climate change. And we've seen it firsthand with COVID-19, for example. The kind of how supply chains could be easily disrupted, posing essentially an existential threat potentially to the firm's viability. So, and from that perspective, greater ESG, commitment, theoretically viewed as positive. So, and that's why what we've seen in the recent years is proliferation of various ESG rating systems. So there are several companies, several entities, I should say, several organizations that provide ratings of ESG compliance, ratings of ESG reports. They request companies to provide information on their ESG disclosures and so on. So more and more firms are providing voluntary ESG reports. Sustainability Accounting Standards Board, which is the organization kind of modeled after FASB, headed actually by former accounting professor Jeff Hales of Georgia State. They're trying to establish kind of more routine or more comparable ESG standards across industries. So this is all great. The big question, I would say, that one has to ask about ESG, whether in fact it truly has an independent value enhancing effect. In other words, of course, whenever you try to assess whether something, particular firm policy enhances value or reduces risk, there's always a question whether is this really that policy or is it something else that's driving it. So, this is again PwC diagram as to how, kind of summarizes how ESG might have this potentially positive impact. And, you can see, that the company makes disclosures about its ESG activities. Those disclosures are rated by ESG rating issuers and providers. Also now you have a proliferation of ESG indices, stock market indices. So there is a whole discipline, if you will, or branch of investing called socially responsible investing, where certain types of funds or are organized on the basis of a certain type of maybe any sort of firm characteristics. You can, create any fund you want, but in particular on ESG ratings and so on. If you want to invest in a fund that has certain socially responsible orientation, so you can invest on the basis of ESG ratings. Those funds, then cater to a particular type of investors that prefer to invest in certain types of companies. Investor buys them, and that hopefully drives up the value to the degree that if ESG ratings are important, the demand for investments goes up, and that of course increases the stock price, right, if the investors truly care. Again, the question still that one has to ask is whether in fact there is an independent ESG effect. And that's where I remain one of those skeptics. Is there a really ESG effect? Interestingly enough, there was a hearing of Investment Advisory Committee of the SEC, and they've dedicated a non-trivial amount of time to ESG. And, there was one professor, I forgot, from one of the top business schools, was asked, well, can you talk about, exactly how it enhances value? And he couldn't really give any, at that hearing, he didn't really give any clear evidence. I mean, there is some research, but really not a lot of papers that establish that. But he said, well, basically, why would it not, right? If you do all those wonderful things, you're on the long term, your return on assets should go up. Well, but the problem is again that these companies that are, provide ESG disclosure, they do many other wonderful things. And to which degree is it truly just window dressing? And I'm not saying it is window dressing or not. I'm just saying that I don't think, obviously people think ESG is important. Maybe it's important for its own sake. I don't know. But I think there's still not enough evidence to say that it has its own independent effect. But certainly what there is evidence of is that people want it, right? And I think there are funds that people talk about it. And when something like this happens, if it's important to investors, it kind of will get a little life of its own, and will enhance, probably result in increased demand for shares, no matter what. Whether in fact it necessarily right now translates in increased performance on the long term, it will take probably a decade for us to really come to a conclusion whether independent impact of ESG compliance or ESG commitment, I should say, is positive or not. So here's obviously the accounting firms are very fast to get on this bandwagon. They very much want to be part of this ESG bonanza. There are examinations to be done, quote unquote audits of ESG data. This is not an audit technically, but I was listening to a webcast from Ravenpack, which is the investment data provider, and they were talking about how certain companies already have Big Four opining, providing examination reports of the ESG reports. It's great, right? I mean, because the problem is that right now ESG reporting is entirely voluntary, and you don't know to which degree that anything in those reports is truthful or not. So, skeptical investors want an independent third-party assurance of it. So, it's great for audit firms to come in and provide such assurance. And we do have, attestation, examination framework to do that. Very similar to auditing standards in some ways, but, it's great business. Here EY, kind of talks about about the embarkment project for inclusive capitalism, on sustainable inclusive growth. One thing I have to say that I am a personal believer in the fact that we have an inequality problem in our society, a very serious problem in inequality in our society, and I do think that in the long term, this economic inequality edge will make things a lot worse for us. And so I'm not sure if the ESG necessarily is the answer here. But I'm personally a great supporter of corporations kind of getting out of this pure shareholder value maximization um, um, paradigm and thinking about, well, what do we need to do for society at large? How do we reduce social problems and economic problems? The fact that, and we don't need to go very far. I think COVID-19 has pretty much established what the cost of this inequality is. We see, how probably economic inequality contributed to such greater negative impact of COVID-19 in the African American community, where there are rates of diabetes um, and other kind of risk factors that contribute to greater mortality, morbidity of COVID-19 are so much higher because of lack of access to higher quality healthcare, lack of access to healthier foods because of higher level of poverty in the long term. It has these horrible consequences. And, you know, um, so I don't know what kind of other proof you need that corporations need to step in and be more responsible in addressing societal problems at large, providing equitable access to healthcare, providing equitable access to health for their employees, making sure they can have better lives. I think everyone will be better off as a result. I don't know if necessarily we need ESG reporting for that purpose. But certainly it's a good thing that there's a greater attention being paid to this notion of inclusive capitalism. And I think, again, in the end of the day, that inclusive capitalism kind of it's not out of some sort of altruistic reasons that they're doing it. They understand that that you need to have inequality problem dealt with because in the long term it will come back and bite you really, really badly. And what we're seeing now is just the beginning of it. The more this inequality will in healthcare and other areas, the less access people, the more disparity in access to opportunities people perceive, the more social unrest you're going to have. So I think corporations are smart entities, shareholders are smart people. They understand that for their own interests, they need to be paying more attention to those issues. And I personally think it's a good thing because it's nothing really new. If you think about all the way from the 1960s, maybe early 1970s, that was sort of in some ways the attitude of American corporations. I have a neighbor who is 92 years old or 91 years old. Her husband used to work for IBM, and he died 20-something years ago. She still to this day is getting her husband's survivor-based pension. And I think that's where they ought to be. I mean, we need to make sure we take care of people better, and that will, in the end of the day, contribute to long-term success of the American capitalism. So, as I already mentioned, Investor Advisory Committee of the SEC had discussed the issue of ESG disclosure quite a bit. They've gotten a lot of feedback from constituents about asking the SEC to either require some type of ESG disclosure or provide for some consistency of ESG disclosure, because so right now the way the system works is that the company in their MD&A can provide anything that they believe is material to their operations. So it's kind of discretionary. If you believe that that certain types of ESG disclosures should be seen by your investors, then they'll be provided in the 10K, and if not, then you don't. And of course, this issue of necessity or usefulness of these disclosures, it's very subjective for that reason. So, some investors, for example, believe that it's critical, right? If you're more socially responsibly oriented, then you want it, right? If you're an ESG provider, you want that disclosure. Over time, there's been a lot of debate. I think the majority of investment advisory committee leans towards asking the SEC to provide it. The commission itself kind of understandably split over party lines. The chairman in his statements seems to be on the fence and on this, and with my interpretation, what he's saying is he doesn't want it. He's open to talking about it, but doesn't want it. The more conservative members of the commission obviously are very skeptical towards it. They view it probably, my interpretation here, I want to be very careful, as kind of another attempt to bring in politics, if you will, or if you will, liberal politics in the investment and disclosure process. And obviously the Democratic members of the commission, in particular Allison Lee, who is the newest member of the commission, is very much wanted. The question then it really becomes, so that's how the chairman is kind of balancing its act. He kind of says, okay, you can provide whatever you want if it's material. Why do we need to regulate? And that's why do we need to regulate this disclosure? So here's, in some ways, the investor advisory committee responds to that. So they say this recommendation asserts that the time has come for SEC to address this issue. Addressing ESG disclosure now will A, provide investors with the material, comparable, consistent information they need to make investment and voting decisions. B, provide issuers with a framework to disclose material, decision useful, comparable, and consistent information in respect of their own businesses, rather than current situation where investors largely rely on third-party ESG providers, which should not always be reliable, consistent, and necessarily material. Level the playing field among all U.S. issuers, regardless of market cap size, ensure and continued flow of capital, enable SEC to take control of ESG disclosures for U.S. capital markets. So here what they're basically saying, look, companies are already been inundated with this ESG disclosure demands. There's great degree of non-uniformity of doing it. There's different organizations, SASB and some others that have their standards. SASB actually has a bunch of industry-specific standards. It's getting way too complicated, right? And the honor is on firms, because the thing is, one of the things that I heard in one of the webcasts that I was listening to is that, there's a lot, companies are inundated with requests for this ESG disclosure information. And if they refuse to do it, if they refuse to provide it or be responsive to it for whatever reason, because maybe they just don't want to release this information for a variety of reasons, they get penalized. They get kind of, the ESG providers, they rate firms. And so one of them, for example, I was listening to, they give a very negative rating to Equifax, even prior to Equifax data breach, for, kind of problems with the data guarding policies, data protection policies. And so, there are real consequences to it. So that's basically what the investment advisory committee is saying. SEC, it's time for us to step in and kind of like deal with this mess. And the mood is changing. The first time I was at the commission, kind of the whole conversation was, why bother with this stuff? This is really not accounting. We don't, this is kind of socialism essentially. This is a private opinion being voiced. Today, in more recent years, what I've heard is, it's time for us to get into this. Partly is because, and I'm talking about kind of people that are among accounting and auditing kind of audience, and partly because, of course, the cynical response might be that accounting industry, auditing industry would benefit. It's extra business, extra assurance you can provide. It's complicated. You can do a lot of different things. So this is kind of cool stuff, that we can make our extra money on this. But that's a cynical response, I would say. Here, the statement continues. The plethora of ESG data providers, all with the different standards and criteria, has led to significant burden on US issuers. Each data provider uses different information sources, conducts its analysis, and produces worst product. Many provide lengthy questionnaires to companies, some with many hundreds of questions. Responding to this form takes a great time and effort, and it often depends on internal reporting systems. So that's basically the reason why the committee is saying, come on, let's just kind of step in, make it easier on everybody rather than deal with this mess. So the companies that fail to fully comply with responding risk being really poorly being issued with low ESG ratings, as I said earlier. I mentioned Commissioner Lee, who has been a very vocal proponent, I would say, of the ESG disclosures, and she gave a speech recently which kind of underscores her view. A growing body of evidence demonstrates the importance of this information to investors in relation to financial performance. That's why we're seeing some of the largest asset managers in the world join the chorus of voices affirming the critical importance of this information to the investment risk and long-term performance. Here, I beg to disagree. It's interesting whenever they talk about evidence that it sustains long-term performance. Anytime I look at speeches and stuff like that, what they actually cite in support of that, it's not a lot of actual academic evidence. There is some initial papers that look at that and that suggest that that's the case, but nothing overwhelming to that effect. And there are some really respected academics, and I'm going to mention one in particular, who are really skeptical about this, how much of it is really true versus hype. So BlackRock, for example, which is this biggest investment fund in the world, one of the biggest ones, their chairman had come out with as a strong endorsement of ESG. Here's some internal, I wouldn't call it an academic paper, but this is internal BlackRock research that's gotten published. They talk about ESG factor, essentially portfolio factor. So it's, the paper says, environmental social governance signals are an important part of factor-based investment strategies, as they can stem from same economic rationales as general factor premiums. Well, that's the issue, I would say. How do you distinguish one from the other? Because factors are broad and diversified, building portfolios by jointly optimizing factor exposures with ESG and carbon outcomes results in similar historical performance as benchmark factor portfolios which do not include those considerations. Okay, so they're basically saying, like, there is no separate effect. I would say that's how I interpret that statement. We show how sustainable signals, which often involve alternative data, can be integrated with definitions of factors themselves. We offer two examples of green intangible value, corporate culture quality, which enhance traditional financial value and quality factors respectively. So basically what they're saying in this paper is that, like if you just simply take this bunch of ESG factors, form a portfolio, they're not going to get much different than you'd get from a regular, high quality form portfolio. It takes some creativity to really just flesh out something separate about these ESG factors, which is something that Shivaraj Gopal mentions in the article I'll show you as well. So no, but nonetheless, this is considered very important. And so, for instance, we can see more and more very serious investment people, investment professionals getting into this whole business of ESG and carbon monoxide and global warming. So here's Wall Street Journal article ran a very nice story on Robert Litterman, who is highly respected in the investment industry, former Goldman quant, taking on climate change. So he's looking at how climate change affects investing and so on. So here's an excerpt of this article. The coronavirus crisis shows the cost of failing to properly assess risks. It's the perfect example when you have risk management problems. It's urgent, you don't know how much time you have it. But coronavirus, we wasted so many weeks. His main focus is climate change. We've got to slam on brakes on carbon emissions to stop climate change. It's way past time. So so here I think what he's underscoring is the importance of ESG for risk management purposes. Um, and the fact that in the long term it could expose, failure to address ESG risks could expose firms to some real serious problems. And that to me is a little bit more acceptable than claiming that, just all kinds of activities then their own enhance shareholder value and increase cash flows. I think from a risk story, a risk management story is a much more reasonable story. That because we can actually come up with very quick explanations. If most of the consensus is that global warming will disrupt our lives more and more, it will inevitably, in the long term, disrupt supply chains, kind of have all kinds of negative effects. Inequality will exacerbate companies to very serious political risk, litigation, and so on. So, and that's where I think ESG has a much greater potential and role, and that's the reason why serious people kind of take it. They don't dismiss it. So there's some question is what ESG is: environmental, social governance. Environmental obviously deals with carbon monoxide, climate change. On social has to do with diversity, commitment to people, impact on employees. Governance has to do with just the way company is governed. So which one is more important? And this article kind of talks about how social has been lost has been overshadowed by environment and governance concerns. And what's interesting that this is in light of kind of the recent developments in the country with respect to policing and problems with police brutality and problems with diversity and problems with the racial inequality that we're facing. Corporations are becoming much more, again, acutely focused on diversity aspects of ESG, and this was brought up in the Ravensback conversation. And so, it's basically kind of like, and that's a very broad term, right? So ESG, and so which one do you emphasize more? And I guess you got to emphasize all three in this process. And the challenge that the SEC will face is because this is such a broad term. Is what sort of disclosures, if they actually take it on, what sort of disclosures will they want to emphasize? That's the big question, I would say. This is the continued excerpt from this article. Of course, the social element of ESG has to do with the human capital element, right? And that's the other area where investment advisor committee of the SEC has been very much focused on human capital disclosures. We want to know much more about your employees. So decisions around human capital will vary materially across different sectors, dictated by a range of factors, including changes in product demand, government-mandated shutdowns, liquidity type of workforce, and employees' ability to work remotely. The bottom line is employees are the key source for almost all companies, and actions taken proactively to support them throughout the crisis could play a key role in employee loyalty and satisfaction over time. So Human Capital Coalition is another organization that's been pushing SEC for greater disclosure of human capital. And human capital basically is more disclosures about people that work for you. So they ask for workplace safety disclosures. They ask for labor composition, labor turnover, part-time versus full-time, gender composition, and so on. The idea is that, of course, all of those disclosures somehow will be useful to investors in assessing the long-term value prospects of the firm. The problem that the challenge that we're facing is that where do you stop, right? One of the issues that I personally care very much about, and this is a non-trivial issue working at the SEC, is that disclosure overload. The 10K is already crazy long, right? For most companies, it could be a couple of hundred pages. Most humans don't read it. The computers read it. And when the computers read it, the algorithms read it, they don't even read it. And they just look for changes from year to year. So, what is actually important, and that's to be disclosed, without killing the importance of the document. And that's what I think Chairman Clayton is trying to balance. He's basically saying, well, like, why don't we just leave it up to firms to decide what's material? Because otherwise, everybody wants everything. Some of the investor groups' attitude, I've noticed, just from reading their comment letters on various rulemakings, is that they just want more information, no matter what. More information is always good. Well, I mean, we know that investors have limited attention and also invest in, and disclosure could be confusing. And disclosure, when there's a lot of it, could be used to obfuscate data. More important, right? Because we all know that we can essentially use the information overload to hide or divert attention from the important things, and so that's a non-trivial debate that we're getting into here. ESG disclosures, or drive for ESG, has its own number of skeptics. Wall Street Journal this year ran several articles which were very critical of this whole drive for ESG. So they refer to Sustainability Accounting Standards Board as Bloomberg's business nanny. So they essentially accused SASB of just promoting Michael Bloomberg, who is the former presidential candidate and obviously multi-billionaire and former mayor of New York, of promoting a social progressive politics brand through this board. And the argument is, we kind of summarize here. Jeffrey Hales, who is chair of the SASB, claims that ESG information is material. Social values can have a financial impact on the company. So, and the basic criticism that they have is that's in his opinion. So the last line of this passage: whenever an authoritative body imposes materiality rules or standards, it's substituting generalized collective judgments for specific individual judgments. And there is no reason to suppose that the collective judgments always are superior. So this is kind of individualistic versus collectivist argument. Do we need Jeffrey Hales of this world to decide for us what we want? If you want this information, you can always ask for it, and that's what's going on right now. Why do we need to impose on firms this additional, potentially onerous requirements? And so, of course, what's interesting is that BlackRock has asked for this data, and they endorsed providing of this data. But for other firms, but itself, it doesn't follow SASB requirements to disclose the liquidity of open-end mutual funds, because SEC has concluded doing so may impose significant risk of confusing and misleading investors. Bloomberg LP, believe it or not, won't disclose data breaches or counties where core products or services are subject to government-required monitoring, blocking, counting, filtering, and censoring. So basically, and then this may explain why many companies say SASB standards are laboriously irrelevant. So Wall Street Journal essentially is accusing SASB and BlackRock of being, BlackRock in particular here, and Bloomberg of hypocrisy. They're basically saying, well, you guys are asking for this, that the investors should provide this data, that they should follow SASB, but you yourself don't follow it because you don't want to be potentially harmed by it. So this is why there was actually a notable dissent at the Investor Advisory Council to ask for this disclosure by Mr. Stephen Holmes, and where he basically says, I think the whole ESG topic is best addressed by private parties rather than opining and mandating some central group such as SEC. The reason why the private parties have not yet come to broad singular consensus on ESG is that ESG is a complex topic with many aspects that vary widely from one company to another and from one investor to another. One size does not fit all. SEC already mandates disclosures of material topics as defined by securities laws and as determined by the filer. I think that it's highly unrealistic to expect that the SEC will be able to come up with a broadly useful ESG reporting solution or benchmark and lowest common denominator. And I will be honest, I actually think I agree with this guy. Personally, I think Chairman Clayton personally, again, it's my personal biased opinion, is wise in kind of treading very carefully here, because sometimes, regulating things like that that are so complicated, so individualistic to the firm, actually creates more problems than solutions. And Shivaraj Gopal, who is an accounting professor at Columbia, in that regard, has been writing a series of articles that basically say that, if you look at the performance of ESG firms, they're just, and supposedly higher performance, it's just basically blue chip stocks, high tech stocks that we know why they're performing so much better than everyone else. It has little to do with ESG, if anything. It's just kind of basically ESG is incidental to, better ESG reporting. It's incidental to those firms being really excellent firms on their own. So, a lot of interesting debate here. We'll see how it goes. I tend to be more on the skeptical side here. Even I'm open to potentially more disclosure. Personally, I am a big believer in this inclusive capitalism and inequality reduction and corporate commitment to that, but not necessarily in my mind, providing more paperwork and typing more data is the solution to that. But okay, I guess time will show who is right. Thanks so much for listening.